Welcome back to EDS, and in this video I'm going to show you step by step how to thrive in volatile markets. Now we're going to be writing options contracts, which means we are going to be short options contracts, and anytime you're short, that means you want to sell high and buy low. Now volatility has an effect on option prices. When volatility rises, option prices rise. So the more volatile a market is, the more volatility, the higher the implied volatility, the higher the option price is, which is good for us because we want to sell when option prices are high and then play the contraction back down to the mean and further below. And one of the reasons why this works so well is because volatility is mean reverting. So let's get straight into it. And the first thing you want to do is just open up your watch list. It can be any watch list. I've just got a pre-made watch list here. That's made up of underlyings with high options volume. You can use whatever you like, it doesn't matter. And what you want to do is you want to have up this IV rank column in your watch list, and you want to order everything from high to low IV rank. IV rank is going to tell you where implied volatility is on a scale of between 0 and 100 relative to itself over the past year. So you can have, without IV rank, you won't know where IV is relative to that specific underlying. So for example, we have we have TLRY here with an IV rank of 59.6, and we have Palantir with an IV rank of 57.5. So they have very similar IV ranks. However, if we look at the absolute IV levels, TLRY has an IV level of 118% and Palantir is 67%. So without IV rank, we wouldn't be able to know where IV is with respect to that specific underlyings, highs and lows of volatility over the past year, if that makes sense. So IV rank is a very important indicator or very important metric that we're going to use, and we only want to look at things to trade that have an IV rank of at least 30. Okay, so our cutoff point would be around here at BAC, which is Bank of America. Anything with an IV rank of over 30 is considered high. Over 50 is considered very high. I like to be in a mid to high sort of range. So you just want to go down the list and see what would fit well in your portfolio. The larger the product, i.e. the more money it's trading for, the more buying power is going to be required. So if you have a smaller account, maybe stick to things that are $50 or less. If you have a larger account, by all means choose whatever you like. Whatever you do choose, just make sure it fits well in your portfolio. Keep things nice and diverse. Don't be too heavy in any one sector or underlying. So let's just have a look at Palantir. It's trading at just under $105 a share. It's got an IV rank of 57.8 and an absolute IV level of 67%. So let's pull up the trade tab, which is where we can see a list of expiration dates, option expiration dates for that underlying. And the one that we want to pick needs to be between 30 and 60 days out in time. And we also want it to be a monthly expiration date, not a weekly. So we've got March 21st, which is 45 days out. 45 days is perfect for us. So we're going to open up March 21st, and now we are presented with the options chain. So very quickly, we have calls on the left, puts on the right. We have our standard deviation levels, which are denoted by these dotted blue lines. We have our strikes going down the middle, and we have where our current price is denoted by this horizontal orange line going through the middle here. That shows us where the price of Palantir is with respect to the strikes. We also have our expected move in the top right in parentheses. In this case, it's plus or minus 16.33, and that's also visually represented by this vertical orange bar here as well. We've got delta, our positive delta on the call side, and negative delta on the put side. So what we want to do is very simply sell one call and one put, and we want to sell them outside of the expected move, because whenever we are writing contracts, whenever we are short a contract, we want price to stay away from that contract. We want our contracts to stay out of the money. Okay, so in order to get a high probability of success, we just simply need to sell outside of this expected move. And the further out you go, the less premium you will collect. So a happy balance or medium, in my opinion, is to be around the 1 standard deviation level, and that's going to typically line up with a delta of around 15 to 20. So let's start off with delta. We've got an 18 delta here on the call side at the 135 strike, and we have a 15 delta on the put side at the 85 strike. Now both of these contracts are in and around the 1 standard deviation level. They are outside of the expected move, and they're between 15 and 20 deltas, and all three of those points should line up, and you can use it as a sort of checklist, or use it as points of confluence for your trade entries. So what's actually happening here? Well, we've now created a range for ourselves, and we want price to be within this range at expiration, which is going to be in 45 days time. Now what's the chance of that happening, or what's the chance of breaking even or making a penny on this trade? Well, to know that, we have our pop, which is down here in the bottom left, which is probability of profit, and that's currently at 75%. So we have a 75% chance of making at least 1 penny on this trade, and that's if we hold all the way to expiration. However, what if we don't want to hold all the way till expiration, and say if we want to get out at 50% of max profit? Well, we have our P50 number here, which tells us the chance of getting out at, or hitting a 50% profit level at some point over the next 45 days, and that's currently averaging about 85% right now. So we've got probabilities of success of between 75 and 85%, and that's before taking into account that implied volatility is generally overstated compared to actual volatility. So if we wanted to get out of this position at say 50% of max profit, we probably got close to a 90% chance of success, and if we wanted to hold to expiration, we got probably close to an 80% chance of success. So very, very high probabilities. Now, how much money can we make off of this trade? So this is our mid price in the bottom middle here, 3.94. That's what we would look to try and get filled at. So that's $3.94 per share. Equities have a contract multiplier of 100, so you multiply that out by 100, and we get our max profit of $395. That's what we would collect upfront in premium, and that would get added to our brokerage account cash balance automatically by our broker as soon as the order gets filled. And our broker is going to require just under 5.8k in buying power to open this position. So as we can see, it's a fair return on capital for 45 days time, a little under 10%, which isn't too bad. However, you might be thinking that's a lot of buying power to tie up. Maybe you don't want to tie up that much buying power. Maybe you have a smaller account, and that's absolutely fine. So what I'm going to do is show you how to manipulate this position to fit inside a smaller portfolio, or just simply get a higher return if you wanted it. So what we're going to do is we're going to use some of this premium to buy some contracts to cover our short contracts. So let's say, for example, if we go $10 wide, so let's say we go to the 145 strike and we buy the 145 strike, okay, and then we can do the same thing on the put side. We can go $10 wide to the 75 strike, and we can simply buy that contract as well. And now we've created a spread on either side, and what that's done is it's limited our loss. So before we had an unlimited loss potential, now it's capped. It's capped at whatever the difference is between the spread minus the premium that we collect up front, times by the contract multiplier, and that's how we arrive at our max loss of 787 here. And our broker is now only going to require $798 in buying power, whereas before it was 5.8k. Now it's only $800. So what you'll notice is we are going to now be collecting less premium because we've used some of that premium to pay for these long contracts. However, our buying power requirement has significantly been reduced, and we now get a higher return on capital. So we'd be looking at collecting $203, and our broker is going to require $798 to open this position. If that was still too much for you, you could simply go in a little bit and make it $5 wide on either side instead of 10, and now we will collect less premium, but our buying power requirement has reduced even further, and now we do get a slightly higher return on capital. And the trade-off of this is that you are going to have slightly lower probabilities of success. Now, if you wanted an even higher return on capital, you can be more aggressive. Say if you go to the 25 delta, and you keep it $5 wide. There isn't a 25 delta on the put side, so we'll just go to the 22 delta, but we keep everything $5 wide. And now we'll collect $1.87 up front, and so we're going to collect a max profit of just under $200 in premium, and our broker is going to require a little over $300 in buying power. So now we have a high return on capital. And when you are looking for a defined risk trade like this, you want to make sure that you are collecting about 1/3 the width of the strike and premium. So if you had a $10 wide spread, you'd want to be collecting around or at least $333 on entry. So about 1/3 the width of the spread. Okay. So that is how you can find and manipulate positions to fit inside your portfolio. Now you do need to pay attention to how much buying power you are allocating to your positions. So one way to figure that out, or keep tabs and make sure you're not over leveraging yourself and keep your position sizing in check, is that we have created a free position sizing template that's available for everybody to use. The link is in the description. Just click on free position sizing template. It'll take you over to the spreadsheet. And what you can do here is enter in the size of your portfolio, say if it's $25,000, and then below that you can enter in what the current VIX level is. So let's just say if it's 12.7, and then everything will then be automatically calculated for you. All you need to do at this point is just use this information to form the backbone of your portfolio, and over the long run you'll be absolutely fine. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up, and inside you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you ever get stuck, you can speak directly with myself or with other like-minded individuals. There's a 100% money back guarantee, so once you have studied the full course and followed some of our trades for at least 6 months, if at that point you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, whatever price you get in at, that's the price that you are locked in at for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill, and once you've learned it, it's something that you can take with you for the rest of your life. No one can ever take it away from you. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You are, of course, always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.